Welcome back. We are now in segment 6.14, and in this segment we'll be discussing about non-current assets. So far we have under assets we have discussed two major items, that is the current assets and fixed assets. So we discussed there two more other categories, that is the non-current assets and intangible assets. We have already completed all items under liabilities. So in this segment we'll be discussing about non-current assets. So these are the various items that you can possibly encounter under non-current assets. So you have investments in subsidiary companies, advance to capital goods suppliers, deferred receivables, deposits, deferred tax asset, receivables above 6 months. These two we have actually discussed a bit in the earlier segment, right? Under deferred tax liability we have discussed. Deferred tax asset actually we have discussed under deferred tax liability. This is just the opposite effect of deferred tax liability. Receivables anyway we already discussed under current assets. So we will see what is the receivables above 6 months, and then their dues from directors. This also we partially looked into when discussing about salaries payable, right? That advances recoverable and cash on kind. In that segment we already had a brief look. And anyway, we will once again discuss all these items. Investments in subsidiary companies. Whenever you see this classification, you have to classify it as a. Whenever you see this item, you have to classify as a non-current asset in the same data. So what is a subsidiary company? Subsidiary company or group company, right? You'll hear these terms, group firm or sister firm, right? So it means that if two companies A and B, right, are group companies or subsidiary, what effectively we are saying is there is a commonality of management, right? There is a commonality of management. Okay, of course commonality of management per se need not be the reason why we classify two companies as group companies. That alone is not sufficient. What we're actually saying is a controlling interest, right? So take for example, say for example A is a person, right? He's a proprietor of a firm which is engaged in say trading of some FMCG products, right? So let us say this turnover has reached a stage where he doesn't want to increase it anymore further. He doesn't want to increase the turnover beyond a point, because maybe this unit is eligible for certain concessions, being a small unit. Maybe for some reason he doesn't want to increase the turnover of this firm beyond a point. So what he does, he floats a different firm, and he is also a proprietor. This is a sole proprietorship firm engaged in some trading of maybe same activity or some other activity, right? Let us assume same activity, right? So if you see here, even though these are two separate firms, there is a commonality of management. So here the same person, right? The same person is the proprietor in both these firms. So here we can say these two are group companies, right? These are highly related. So what we are saying, why we track subsidiary companies? See, when you're given a balance sheet of a company XYZ, so we are analyzing this company. Why at all are we concerned about some other company, right? Why are we concerned about some other company which is a group company? This company has got a separate balance sheet. This ABC company has got a separate balance sheet. This has got separate financials. This activity is different. It is engaging something. It has its own setup, right? It has own employees, own production. Something. Everything is different. Then why are we concerned when we are analyzing this company? Why at all are we concerned about this other company? So there are a couple of reasons for it. One reason could be a failure in ABC might ultimately lead to a failure in XYZ. Failure in ABC might imply a failure of XYZ, because ultimately the management is same in both the cases. The ownership is same. When you have the same owner or a common ownership, say for example here, this company has this company of this proprietor B is in some problem. There is some financial problem, right? He needs to so if it is a sole proprietorship firm, let this company has wound up, terminated its business. So if he has to settle the dues of the various lenders, maybe the assets of the company are not sufficient, like, right? He has wound up the company, and after selling the assets of this company, it's not sufficient to pay all the lenders. So what he does as a sole proprietor, he has to make good that shortfall from his personal funds, because it's a proprietorship firm. Say for example, in this company, there are total outside liabilities of some 80 lakhs. But when he sold all the assets of this business, various inventory, fixed assets, he could realize only 60 lakhs. So who brings the 20 lakhs balance? The proprietor, obviously. So this 20 lakhs has to be brought in by the proprietor. But see here, since the proprietor is also running another firm, right? And when we sanction funds to this company, we analyze the financial position, the soundness, the financial soundness of this proprietor. So now the 20 lakhs, the proprietor net worth, the net worth of the proprietor, say for example he has got some a land, and now he has sold that land to settle this balance 20 lakhs. So when we are analyzing the when we have sanctioned limits to A, when we analyze the financial position, the net worth of the person, maybe we were satisfied of his net worth. It was some 50 lakhs, but now 20 lakhs is coming down, and that's the reason why we have to always track the various businesses into which the owner is into. Maybe B is just one more company. Maybe there is another company C where he's a partner. There may be some 3 partners and he's one of the partner. Now you know that partnership firm has got unlimited liability. The partners have unlimited liability. So even the personal assets have to be sold in case the firm has some pending dues to be settled. So here when we speaking of group concept, what we're saying is we want to know which are all the companies that the owner of this A is related. He can be a proprietor in some other firm, or he could be a partner in some a partnership firm which has got some other partners, maybe 3 or 4 partners, of which he is one of the partner, or he's a director in one of the companies. So in any of the what we are saying is what are the related firms into which this person is into, so that we can track the performance of those companies to see if there is any problem. We want to see the financials of this company. If this company is some in problem, if there is some problem with this company, maybe it will have an effect on this company as well, right? Maybe this company funds, maybe, and that brings us to the second point. Maybe the funds will be diverted from this company which you have sanctioned to this company. Maybe that can happen. You see here B has ultimately fallen short by 20 lakhs. Maybe then this proprietor will be tempted to divert the funds. Maybe this company has got some working capital limit sanctioned by the bank, by his banker. Maybe this funds may be diverted here. You don't know what's going to happen. That's why you have to always track the financial positions of our companies. So you have to always track the financial position of the company. If you have sanction limits to XYZ, this XYZ has some group companies A, B, C. You have to track the financial positions of these companies, even though I'm saying even though there are no transactions or there are no dealings with one another. Even though there are no transactions, even though they're totally unrelated, even though they're not transacting with one another, even then we have to analyze the position. But if there are related, if there are transactions, if there are some dealings, then definitely, in this case, definitely you have to go. I'm saying even if there is no transaction, you have to analyze these companies to know the overall financial position of this group. But for example, if there are transactions, then definitely you have to, this is the case where definitely you have to analyze the position. If XYZ has an item in its balance sheet called, let us say, investment in A. So this company has invested some 20 lakhs into the capital of A, right? Now in this case you are definitely interested in analyzing A's financials, and first of all, have you approved this? Are you, as a banker, are you willing, right? Are you comfortable with this position? Is the financial position of the company sound enough to allow 20 lakhs to be diverted to the group company? As a banker, are you comfortable, and is it something to be allowed? Now these are questions to be asked. That's why whenever we see a balance sheet, first of all, you have to, whenever you see analyze the financial position of a company, it's very important to know what are the group companies. You should always ask these questions, right? If it's a proprietorship firm, just when you come across the borrower, right, when he comes to the bank, have an informal discussion, ask him whether he is into any other business, any other group companies. Either he could be he has a firm where he is the sole proprietor, or ask him whether you are a partner in some other firm, or are you a director? Are you interested in any other companies, right? Either in the same activity or different activity, doesn't matter, right? Just get to know that, and then we should analyze the financial position of those companies. That is the first point. That is, you have to see the financial position of the group companies, financials of group companies. Second, you have to see whether there are any investments in this applicant company. In the applicant company, if there are any investments in group firms, whether this firm which you have sanctioned limits has diverted, let us not use the term diversion, it is a negative term, maybe he has got some investments in group company, whether he's got investment in some other group company, right? Then you should see whether it's a diversion or not. Diversion is actually a negative term. See, there could be genuine reasons for investing in the group company. Right, they could be genuine reasons. Now you have to find out as a banker whether the reason is genuine, whether you are comfortable with this, whether a permission from the bank has been taken, whether it adversely affects the interest of the banker. Then it will be a diversion, right? So here, if so even if there is no commonality of management, if A exercises significant control over B, that is the factor which we consider. There should be controlling interest. Whenever A exercises significant control over B, then we call them two firms as a group firm. Mere commonality and management usually will not doesn't we cannot say they are group company. Anyway, banks will use their own judgment. There are no rules in this regard to determine whether two companies are group or not. Actually, the branch manager will be the best person to judge. Right? Banks should use their own judgment. Will use their own judgment to determine whether two companies are group companies or not. Sometimes, even though there is definitely, you know that there are two group companies, sometimes banks, what they do, they say they are not group concerns. Why? Because, say for example, we are extending limits to 20 lakhs to this firm. Right, now the proprietor says now this proprietor of this firm comes and applies for another 20 lakhs to this company. But the branch manager, maybe he has only sanctioning limit of powers of 25 lakhs. So already has sanctioned 20 lakhs. Maybe for the group as a whole, his powers is only 25 lakhs. Right, now he cannot sanction this. So what the manager does, even though he knows these two are group companies, right, what he will do, he will record it as not a group company. He will sanction it as a separate entity, keeping silent on the fact that these two are group companies. They will not record this in the process. Now this is not at all a good practice, right? You should always note the group associations between two. Here you will actually hear a lot of people saying that this is a negative point, right? That investments in group companies is a negative point, but you should understand that it will not be a negative point. Okay, see, there might be some genuine business requirement. Then a company may invest in a group company. There's nothing wrong in it. I'm not saying this is wrong. In fact, in many of the major companies, you'll be finding this investing companies. There are many conglomerates, right? There are many huge conglomerates like ITC, right? Reliance, the Tata. They are into various businesses. Now, these cross holdings are something which you will find commonly in major companies, right? One company investing in the group company of other. That is something that you find in common. I'm not saying it's a negative point, right? But just watch out for, especially for small firms, medium firms, when they have more than one company, when there is commonality in management, you just watch out for, especially for this diversion of funds, right? This is what you're, as a banker, you're interested. So take a look at this balance sheet. Now, if you are a banker who has sanctioned funds to this company, you will not be entirely comfortable, right? As a banker, you will not be comfortable with this balance sheet if you are sanctioned limits to this firm. If you see here, the company has some investments in group companies, right? So there are two businesses here, right? In B1, this is the applicant, the company is into some business. Then there is another group company. This is a separate business, right? This is a separate business. We don't know what is this business. There might be some completely they might be related or completely different. We don't know. So if you see this applicant company B1 has some investments in the group company of 95 lakhs. You see here what has happened. This company, the applicant company, which has sanction limits, because we already have a term loan, right? We sanctioned some limits to this company B1. Now this B1 has some investments in the group companies. Actually, if you deduct this 95, let us deduct this 95 from the asset side. 265 minus 95, right? This is 170, right? So if you see, in this business B1, only 170 lakhs are into this business B1. See, if you think of the liabilities as sources of funds, this is something which you already discussed. Liabilities are sources of fund and assets are uses to which these sources have been put forward. The total sources of 265 lakhs, of which, if you see, 170 lakhs and 95 lakhs. Only 170 lakhs are into this business called B1, right? And the rest 95 lakhs have gone into a business called B2. This 265 is comprised of many entities. There are some creditors, some banks. Okay, let us assume for a simple for our understanding, which this will never happen. But let us assume for simplicity that all these funds are bank funds. We never sanction that. This never arises, right? We always insist on borrower's margin. But let us assume that this is a rare scenario where all funds are bank. Will you accept this? When you have sanctioned funds to a company called B1, you have analyzed the financial position of B1. You have assessed the requirement of B1. You came to a conclusion that this company requires 265 lakhs. This company, based on its operations, based on its financial position, you appraise this company, analyze this company, and arrive at a requirement 265, and you sanction this limits to this company called B1, and then that company takes 95 and dumps it, and then the company uses only 170 lakhs, whereas that 95 lakhs, the balance 95 lakhs, it takes to the another company called B2. As a banker, are you going to accept this? No, we are not going to accept it. Why should we? Why? We shouldn't. Why? Because you have sanctioned 265 lakhs to this company, right? You have, based on the requirement for this company, right? For this company of sanction 265 now. Now what this company did? Promoters, they have diverted 95 lakhs. This is what is known as diversion. This is what is known as diversion. Diversion is the funds were not put into use for which they are intended. What is diversion? Diversion is the funds, the end user funds. This is the term which we normally use, right? End user funds. The end user funds was not ensured, means the funds were not put into use for which they are intended. For which they are intended. You sanctioned for one purpose, for the business of B1, but finally they ended up into B2, part of it. This is diversion of funds, right? That's why this is a balance sheet which, as a banker, you are not comfortable. Okay, entire 265 was not sanctioned by the bank. Okay, there is some capital, right? The owners' funds are put together 160, right? Reserves and surplus and capital put together, we had 160. So the owners have 160, bank has sanctioned 75, and there's some outside creditors of 30. So put together 265 lakhs. Now here is the point. We cannot identify whose funds have gone into which asset. Now this 265 as a whole has been apportioned into various other uses. Now you cannot say, now if you ask the promoter, he might say, why are you making such a big issue of this investment? This 95 lakhs have come from our 160, right? Our 160, out of our 160 we had placed 95. So still there is 65 lakhs in this business, right? Now that is a point which you have to consider. Now you have to understand here that whether 65 lakhs capital is sufficient for this business, for the lendings you have made. If you see here, so what banks actually do in that case is, and that is the right way, that is a very correct way, what they do in that case is, they will say, fine, we will not consider your net worth as capital plus reserves. Normally we consider capital plus reserves minus any intangible assets. All right, here there are no intangible assets. Normally this is the net worth. Now bankers will say, and this is the correct thing to do, what they do, we will adjust, we'll calculate what is known as adjusted net worth. What we'll do, we'll deduct your investments from subsidiary companies. So what they'll say, we'll deduct 95 from this 160. Is this clear? So what they will say is, the net worth is 65, that is adjusted net worth. This is a revised net worth, in the sense that the owner's funds of only 65 lakhs are in this business, B1. See, the owners have actually brought in a total of 160 funds, 160 lakhs, right? Both capital and reserves. They have 160 lakhs, but in this business they have only 65. The balance 95 is in some other business, which the bank is not interested in. This is something which we didn't sanction, right? This is a completely different business. So the bank is asking, you might have bought some hundreds and thousands of crores of rupees. We are not bothered. How much of those funds are into this particular business? Only 65 lakhs. So now they will say, for our practical purposes, we will consider your net worth as only 65 lakhs. And we will calculate all ratios, all financial parameters of net worth, wherever net worth is relevant, as 65 lakhs. Say for example, you want to calculate exposure. Exposure, we earlier discussed that it is actually linked to net worth. Say for example, as a bank policy, there is 5 times net worth. So this bank is willing to take an exposure of 5 times the net worth of any company. So what they will take? We'll take only 65. Even though the net worth is 160, now we will take only 5 into 65, right? So 325. Am I right? Yeah, 325. 325 lakhs. This is the maximum exposure we'll be taking. So this is the thing you have to watch out for. Whenever there are investments in group companies, it's always correct to calculate adjusted net worth. And what do you mean by adjusted net worth? It is normal net worth, that is capital plus reserves, minus any intangible assets, minus investments in group company. So what this actually does in effect is, it calculates what are the owner's funds in this particular business, right? So then you will see if the position is satisfactory. If that net worth, that adjusted net worth is sufficient for this for the funds which you are lending, right? Then that's all right, right? Then that is all right. That is something you have to keep in mind. So again, to sum up this, so again to repeat the important points. So when we are financing to a particular company, we are taking a risk, right? we're actually taking a risk. But see, when the company has applied for some limits, like a term loan and some OCC, what it gives is a projections, financial projections. It will say we'll achieve this turnover, say 200 crores. We'll get this profitability, say 20 crores. It is giving us a plan. So based on this plan, based on this projected turnover, right? Based on the profitability, we are actually we are judging the not only the financials, basing on also the management quality, right? The past performance, right? The opinion of the company in the market, right? What are the peers, the competitors thinking of this company, and various other factors. We are taking a judgment call, right? There is a risk involved, but still we are willing to take this risk, and finally we have financed to this company, fully aware of the risk involved in this business. But if the company diverts the funds to a group company, right? And if that company loses, maybe that group company has invested the entire amount in share market and all the money is lost. So how will this borrower company repay? So that is why diversion of funds is a very serious issue. We don't know what those funds are going to do. Ultimately, they might end up in some real estate or share market, and we didn't sanction. But even then, even otherwise, even if it is not into share market or real estate, even if the company, say B2, has invested in its own business and is running the funds, we didn't analyze the financial position of B2. We don't know anything about B2. We never touched B2. We don't know what this business is, what its management is. We don't know what is the management of that company is, the quality. We don't know what the past performance of B2 is, what is the opinion of the company. We never analyze B2. That's why our funds are at risk. See, whenever we sanction, we are aware of the risk, but then we consider various aspects, right? The management quality, the past performance, the financial, the operations in the account, various factors. We, in spite of all the risks, we take a decision, right? That is based on some various inputs. All of these are inputs: management quality, past performance, opinion of the company, the operations, various factors we take. And in spite, we know that this account might turn bad, but still we are taking a risk because we have conducted what is known as an appraisal. But if those funds ultimately land up in some other company which we have not analyzed, we don't know anything about it, so that is our funds, the bank's funds, are at risk. That's why you have to take a diversion of funds as a very serious issue. Any bank will take diversion of funds as a serious issue. In fact, it will be viewed with contempt. You have to understand this, right? Unless there is a genuine requirement. Again, I am repeating, in cases where there is a genuine requirement, this is something you have to take a call. Unless there is a genuine requirement, this is not something that is viewed upon very favorably. So this is something which we discuss, that adjusted net worth. So we have to reduce that net worth by how much amount, that investment in group concerns, right? This is a subsidiary company. So that net worth will then be the input. That this adjusted net worth will be the input for various other formulas where we take net worth as an input. Like for example, TOL by TNW. We have a ratio which we're going to discuss later. TOL by TNW. Here, instead of taking the regular TNW, now we take adjusted TNW, exposure norm, right? Maybe 5 times net worth. Now we'll take this adjusted net worth. So wherever we need to calculate a ratio for which net worth is required, we'll now take a adjusted net worth. Okay. So we discussed earlier, there is something called notes to accounts. In any balance sheet, you'll be having what is known as notes to account. Here there will be an item called related party disclosures. Again, not every balance sheet will be having this, right? If there is a related party transaction, then, and if it's a proper auditing firm, definitely this will be related party transactions. And this is a good place to find which are the group companies which the company has transacted during the year. You should always make it a point to go through this disclosure. In fact, you should go through all the notes to accounts. There is no other option. You have to go to all the notes to account, because notes to account are an integral part to balance sheet, right? They are an integral part. Balance sheet doesn't mean just the financials part, liabilities and assets. What are these figures you see and analyze? No, not just. You have to also go to the significant accounting policies, right? And the notes to accounts. Unless you read the financials in conjunction with the significant accounting policies and notes to account, you will be not making a correct assessment. So for as an example, we can take this balance sheet of Oberoi Realty, right? This is a balance sheet of Oberoi Realty. This is a big group, right? Oberoi is a very big group. Majorly it is into hospitality, like hotels and all. So yeah, I mean, the font seems to be a bit low here. Just please zoom up. I'll read for you what we are interested in is in this balance sheet we had an item called note number 29. This is related party disclosure. So this is what we are interested in. Here we can see the various parties which this company, this Oberoi Realty, has done transactions. These are related parties. So the auditor has listed some related parties where control exists. This is what we are interested in. There is some control exists. This company has controlling interest in these subsidiaries. So this is some Oberoi Constructions, right? So various other companies. Then we have some, you can see here, this is also important, entities where key management personnel has significant influence, right? The management of this company, this Oberoi Realty, has some significant influence, right? Significant influence on these two companies, and this is something which you have to be very careful. This is RS Estate Developers and Oberoi Foundation. So what the auditors are saying is the management of this company, Oberoi Realty, has a significant influence on these two companies. So which means, like, if they for example, if this company and say for example, let us say this company is a raw material supplier. Let us assume that this is a raw material supplier to Oberoi Realty, right? Oberoi Realty is the applicant company which we are analyzing, and these two companies are some, of course they are not they are into real estate, but then let us assume it's a raw material supplier. So if this management of Oberoi Realty has a significant influence on this company, what they can do, when they have to purchase the raw material from the market, they will prefer this particular company. There may be various other suppliers who are willing to sell for a lower amount, but then the management might prefer this particular company because they want to improve maybe the business of this company. So maybe they prefer. So a lot of things can go wrong here. So you have to be careful whenever the management of this particular company has a influence on other company. What we usually call as a controlling interest. It is important. Just commonality of management is not a guiding factor. That's controlling interest. Whenever you have this controlling interest, you have to be very careful. So this balance sheet has further gone on to list the related party transactions. If you see here, so this is additional disclosure which we can rely on. You see here, so to see these various subsidiaries put together, this company has so many subsidiaries. So for these subsidiaries, the company has done these transactions. There is some loan given. See, 42 crores, right? Around 42.4 crores. The company has given loans to subsidiaries, right? And there is some rent receipts, so various other transactions. What is the biggest amount? Loan repayment receipts. So earlier it looks as if this company has extended some loans to the subsidiaries. Now it has loan repayment was received. This is a huge amount, right? Close to 200 crores. So what you have to actually look into here is, right? Are these transactions having any negative impact? Have they any adverse impact on the financials of this company? Now this company cannot keep lending funds to the group companies and neglect its business, because we have sanctioned funds to this company. So you have to see whether these related party transactions, first of all, are they in interest of this company, right? Is there a genuine requirement? Are there genuine trade transactions or just investments in group companies? And second, are they, for this applicant company, are they adversely affecting the financials? You have to check. So this Oberoi Realty balance sheet is a great example of where we have some very good information. Here you can actually, where the disclosure seems to be of very high standard. Here you can see the key management personnel, right? They have given some remuneration details, and the entities where this key management, we have discussed two companies, right? The RS Estate and Oberoi Foundation, right? So these companies, the entities where the key management personnel of this Oberoi Realty have significant influence. For those companies, what they have given additional information. So you have seen the dividend paid, reimbursement of expenses, right? So rent income. So now you can see whether there was now you can judge whether these amounts are very high or not, right? Not directly, we cannot infer directly, but then we can make an assessment whether there was some favor done, right? So in effect, whenever you look at a balance sheet, always go into the related party transactions if available, right? If not, if this breakup is not given, at least look into the balance sheet and the assets. Let us see this investments in subsidiaries or group companies. Whenever you see this figure, just try to get the balance sheets of those companies, those group companies, and analyze those financial positions of that company, and also find out whether they are into the same business or related business or completely different business and business. So whenever you have a investment in group companies, what are the things you have to consider? First of all, you have to inquire with the promoter, right? Inquire with the company representative, whoever it is, inquire whether there are any group companies, right? This is something you have to inquire. So what are group companies? If there is a proprietor. So what are group companies? If there is a proprietor, so whether he is a proprietor in any other firm, whether he has got some other business where he is a proprietor, or whether he is a partner in some other partnership firm, or whether he is a director in some other firm, this is what you have to find, right? If he is a partner, if the firm which you are sanction limits is a partnership firm and you are analyzing the financial position of this company, then you have to take all the partners. Say there are 3 partners, then you have to consider each one of these partners and then check. You have to ask whether this partner is a proprietor, whether he has got his own business, whether he's a partner in some other firm, whether he's also a partner in some other firm, whether he's a director in some other firm. Again, this partner, you ask him whether you have your own business, some proprietary firm do you have, are you a partner in some other business, are you a director, right? Again, for the third partner. So this is what you have to do. Similarly, if the company which you are analyzing is a private limited or a public limited company, then you have to take all the directors. Say for example, there are some 4 directors. Then take all the 4 directors. Again, ask whether they have some own business. Whether are you a proprietor in some firm, are you a partner or a director? Again, right? So what you have to do for each and every the key management persons, who are the key management persons, whether they're directors or partners or proprietor, you have to find out whether they have any interest in some other firms, whether they have a interest in some other firms. Then you have to, what you have to do, once you've inquired that position, then what you have to do, you have to get the balance sheets, get the balance sheets of all the group companies, okay, of all the group companies, and then you have to analyze the financial position independently, right? You have to analyze the financial position of the group companies, okay. So let us call this this company which here C1, right? And there are some group companies. Let us say there are some two group companies you have identified, C2 and C3. Next step, what you have to do, then you have to check whether C1 has an item called investments, right? Investments in subsidiaries or group companies. You have to check this item, right? Even if there is no investments, even then you have to get the balance sheets of the group companies and analyze. That gives you a overall picture of the group, right, as a whole. But especially even if it is not there, but if there is a investment in group concerns, then you have to dig a bit further. What you have to do, then you have to ensure that the financial position, right, the financial position of C1, right, of C1 is not adversely affected due to these investments, right? If it is affected, then you have to take a call what to do, right? And overall what you should do whenever we have this investments, then you have to do something else. What do? You have to calculate what is known as a adjusted net worth. So whether you have adjusted net worth, and take this as input for all other formulas where you have where you use net worth, right? This is what you have to do when there are investments in group companies, right? So we'll start. So we'll look at another non-current asset. So the non-current asset, first item which you discuss is the investments in subsidiaries or group companies. So one more non-current asset would be advance to supplier of capital goods. So this is also a non-current asset. So whenever you see an item called advance to supplier of capital goods in the balance sheet, you have to classify it as a non-current asset in the CMI data. So what is this advance to supplier of capital goods? We have earlier seen under current asset something called advance to raw material suppliers. So we have seen something called advance to raw material suppliers. So there we classified this as a current asset. Why? So what actually is happening there is the amount which you paid, you will get the material since you have paid some advance, right? And you are about to get the material. So you have paid the advance in say June. So definitely you will get the material maybe in July or August. So this is not something which you have to wait for years, right? This is something that's going to happen very quickly, right? So this is a current asset. So what is a current asset? You have paid the amount, but right, the advances you have paid the amount, but the service is not yet availed or the goods are not yet delivered. So this is a current asset. So what is the supply? Why are we not classifying suppliers of capital goods as a current asset? So the point you have to remember here is when we define current asset, we said the current asset is something that can be converted into cash within 1 year. That is what we defined. But there we also spoke of intent, right? It's not just sufficient if we could sell an asset and realize it cash within 1 year. That is not alone the reason why we classify asset as a current asset. This is something which we already discussed. The intent is also important. Say for example, a machinery is there. If you want to sell this machinery, if you go to the market and sell this machinery, definitely you will get cash. Say for example, you are in June. Now you want to sell a machine of your company. Now you go to the market, maybe in 1 or 2 months you find a suitable buyer, and maybe by August you will sell this machinery and realize cash. So just because you were able to sell this machine and realize cash within 1 year doesn't make this a current asset. Machinery is still a fixed asset. In a sense, it's not current. It's not at all a current asset. Why? So even though you could sell and receive cash, even though this asset could be converted into cash within 1 year, the intent is not to sell it. Usually when you purchase a machine, at the time of purchasing the machine, your intent, what is your intent? It is to keep this machine in the production process for some 10 years or whatever is the useful life. Whenever you purchase land, factory land or building, the purpose, your intent is not to sell them. You want to construct some buildings on this land. You want to procure some machinery and undertake production, and whatever your products you manufacture, those you sell and generate some revenue. So that is your plan. So intent is not to sell. So even though the machinery practically you can sell within 1 year, but you're not going to classify it as a current asset. Similarly here, this supplier of capital goods, what we are saying here is you have paid some advance to the supplier of this capital goods, and the capital goods is going to be delivered, let us assume, within 1 year, right? Say for example, we are right now in May, and by September he is going to deliver. But even then you are not going to classify it as a current asset. You have to classify it as a non-current asset. Why? One, the reason is your intent is not to sell it. The second reason is what happens to this item in the next year? Can you say? Can you tell what exactly happens to this item in the next year? Say for example, we are having two balance sheets, 31/3/2013, right, and 31/3/2014, right? We have some items here. One, we have various current assets. We have some fixed assets here. We have some non-current assets here, right? All these are assets. Now let us assume that current assets some figure, let us 100. This is some 120, right? Fixed assets, their total, let us say 900. Okay. Let us assume there is no depreciation. Next year is also 900. Now let us say this non-current asset has only one item. And what is that item? That is advance to capital goods, which you are discussing. So let us say this is 100. So you have to understand that next year. So as on March 13, when you had this set item called non-current asset, when you have given advance to a machinery supplier, next year when the machinery, so for example, we are in March, right? We are given advance. Say for example, somewhere in July 2013. That is in this financial year. That is financial year 13-14. So in this financial year, the machine is delivered. So where will this machine go? So if you see the next year, this non-current asset will become 0, right? And that 100 will actually be moving to gross block because it is now part of machine. This is actually a machine. You have paid advance to a machinery supplier. So earlier, this is not in the form of machine. You have just paid in advance. Now this will be moving into the gross block. Now the gross block will be 900 plus 100. Of course, this is just an advance. Maybe some other amount you have to pay. Let us say 200, whatever it is. So that will be the final gross block in the final fixed assets in the next year. The point is, this current asset is going to be converted into fixed asset next year, and this is going to disappear, right? So this cannot be termed as a current asset because it is nonsense to say this year it is a non-current asset, next year it is a current asset. You can't classify it as a current asset. If you classify it as a current asset, you are saying next year it is in the fixed asset. That is not acceptable, right? So a current asset will move to a current asset. It will not become non-current asset. Similarly, a non-current asset will be in a form of non-current asset or fixed asset. So both are non-current in the broad sense, right? Both are non-current assets in a broad sense. We just classify them as a fixed asset and a non-current asset. So the point you have to understand is this non-current asset next year is going to go into the fixed assets, right? It is going to convert it, get converted into fixed assets. Therefore, you have to classify it as a non-current asset, but not as a current asset. So this item, this non-current asset will be transformed to fixed asset next year, right? So that is why we cannot classify it as a current asset. It is a non-current asset. So whenever you see the item called advance to supplier of capital goods, we classify it as a non-current asset. This is exactly the reason why, if you remember our earlier discussion on current liabilities, right? In current liabilities, we had an item called creditors for capital good. Please go back to the segment and refresh that. There we said creditors for capital goods. Usually they're classifying as current liabilities, but the correct position, we said, even though some banks classify as a current liability, the correct position is to classify it as a term liability. It is exactly for this purpose. See, on the liability side, you are showing it as a current liability. This creditors for capital goods. Whereas on the asset side, you are showing it as a non-current asset, advance to capital goods. You are showing as a non-current asset. So something is not correct here, right? Something is not correct. On the liability side, you are showing it as a current in nature, whereas on the asset side, you are saying it's a not current. So that is not correct. So actually, the correct way is some banks classify this as a term liability, and this is correct. This makes more sense. I'm not saying this is wrong. If your bank classifies this as a current liability, you have to classify, right? That is your bank policy. But it makes more sense to be taking creditors for capital goods as term liability, right? And advance to capital goods as a non-current asset, right? So the next current asset, non-current asset could be deferred receivable. This we already seen on the receivables, where we classify the portion will be due in 1 year as a current asset. So remaining portion obviously will be a non-current asset. Deposits, well, some companies pay deposits. This you are aware. If you had purchased as an individual, if you have purchased a house and you wanted some electricity connection, power connection, you have to pay some deposit. Or if you had a telephone connection, you have to pay some telephone deposit. So deposit is something which goes to the company and it gets blocked. This is not something that will be returned to you, right? Maybe once the connection is terminated, once you once you shift the premises, maybe whatever. This is something which is not written in the normal course. If you have plans to stay in the premises for some 10 years, till the 10 years you won't get back this money, right? So what we are saying is it is not something that is going to be realized. It is not something that is going to be converted into cash within the next 1 year. So what we are saying, it is a non-current asset. Why? This is not going to be converted into cash in the near future. So since it is not going to be returned in the normal course of business and gets blocked, let us classify it as a non-current asset. So deposits always we classify as a non-current asset except fixed deposit. Fixed deposit is something which classifies as a current asset for the reason that we can, if you want to cancel, you can cancel it. Of course, there will be you will be losing some amount, but fine. But you can convert it, right? So fixed deposit is something which we classify as a current asset. But rest of all deposits, right? Lease deposit. There will be something called in contracts. If you have a contractor, you have something called EMD, right? Earnest money deposit, various any deposit, all this telephone deposit, electricity deposit, rent deposit, right? All deposits will be classified as non-current assets. So one more non-current asset is a deferred tax asset. Item of the non-current assets could be deferred tax asset. So we're not going to discuss this item because we discussed this under deferred tax liability, right? Please refer the section under deferred tax liability. There under term liabilities, we have discussed an item called deferred tax liability. We had a lengthy discussion. We had a separate segment devoted to deferred tax liability. Please refer to the section. Deferred tax asset is nothing but the opposite effect of deferred tax liability. So the example which we considered in this segment on deferred tax liability, we said that the company maintains two books of accounts. Say for example, one as per the Companies Act and one as per the IT Act, right? So say for example, the tax to be payable as per the Companies Act is, say for example, it is 10 lakhs. But the IT authorities have demanded a tax. But the IT authorities have said you pay only 8 lakhs. This is as per their assessment. So the company usually pays as per the order of the IT department. So the company has paid only 8 lakhs. But as per the books, it has paid 10 lakhs. Right? As per the books, it has to pay 10 lakhs, but it paid only 8 lakhs. So they'll arise a 2 lakhs deferred tax liability because the company didn't pay 2 lakhs. The company has to pay as per the books, but it didn't pay. So there will arise a deferred tax liability. Deferred tax asset is the opposite effect. So the Companies Act, as per the Companies Act, they arrived at a tax payment of 10 lakhs. As per the Companies Act, you have arrived at a tax payment of 10 lakhs, but the income tax authorities have demanded, say, 12 lakhs. So now you have paid more. As per the books, you have to pay only 10 lakhs, but you paid more, 2 lakhs more. So then in that case, there will arise a deferred tax asset. So please refer to the segment where we discuss deferred tax liability. There we had a detailed example. We did the calculation separately for two methods, right? Companies Act and IT. Please refer that section. So deferred tax asset, whenever you see that item in the balance sheet, please classify it as a non-current asset in the CMI data. So receivables above 6 months. So in the balance sheet, in the current assets, we already discussed there is an item called debtors or accounts receivable, right? Accounts receivable or receivables, just receivables. So what are these? These are, we already supplied the goods, we sold the goods, the goods were delivered to the customer, but the customer didn't pay. This is pending payment. So we have delivered the goods, but payment is not yet received. Why? Because usually we sell it on credit. So since we offer some credit period to the customer, as on the balance sheet date, as on 31/3/2014, say for example, there's an debtors called 100 lakhs. So we gave the time to the customers to pay. So that time has not yet arrived. Maybe the due date is April 10th. So then they will pay. Till that date they have time. So 100 lakhs is not yet due since we sold on credit. So this is a pending payment. We have sold, we have made the sales, but payment is not yet received. That is a receivable which we classify as a current asset because we expect that amount to be realized within the shortly, right? At the most within 3 to 6 months. But if it is above 6 months, you have to understand that here 6 months is a very high time. It's a lot of time. Usually the normal credit period is, if you see in the industry, it is around 30 to 90 days. Rarely you get something more than this. When we are saying this receivable, a particular customer has not paid even after 6 months. So what we are saying, the banks are worried. So CMI data has a classification. So the debtors portion will be classified into debtors less than 6 months, debtors greater than 6 months. So the bankers are interested in knowing this classification. So out of your total debtors, say 100 lakhs, how much of the debtors are above 6 months? Say some 10 lakhs. This is 90 lakhs. 90 lakhs is below 6 months. 10 lakhs is above 6 months. So what the bankers will come to an assessment is, this has a possibility of turning into bad debt. Right? This customer has not paid till 6 months. This is long overdue. 6 months is a huge period, right? So it is long overdue. So we are not just saying this is 6 months. This is greater than 6 months. It could be 8 months, some 12 months. So these are debtors which are maybe greater than 1 year. These are debtors which are pending for more than 6 months. So all these are greater than 6 months. We don't know the individual breakup. There are some very horrible cases here. They could be debtors who are old than 2 years. We don't know, right? So what? So the CMA data will give us an idea of what is the debtors above 6 months. That portion bank is classified as a non-current asset. So current asset is something we say which it can be recovered within 1 year. So these debtors above 6 months, the bankers are doubtful. They get the feeling that this is something that cannot be recovered within 1 year period. So let us classify it as a non-current asset, right? Then there could be an item called dues from directors. If you remember our discussion, advances receivable in cash or kind. This is under current assets which we discussed. There we said that if you have advance given in one case you give advance to a worker, right? He's a factory worker, and in a second example you have given to a director. So here a worker is getting a salary of say 20,000, and he asked for some salary advance. So 2 months salary advance he asked, and you gave him 40,000. So this here classifying as a current asset. This advance is recoverable in cash and coin. This advance, right? This advance you can recover from the employee, because 2 months advance, 2 months salary have given, and this is something you can recover from his work in the next 1 year. Director, whenever even though the director is just as a worker, he is also working in the company and he is entitled to some remuneration. But even then, when you give the loan to a director, this will be classified as a non-current asset. All these dues from the directors, whether you call it loan or advance, whatever it, you classify it as a non-current asset. It actually is not a good practice to extend loans for the company to extend loans to a director, because this is, first of all, this is not a because you can treat it similar to an investment in subsidiary, right? This is an investment that is going outside the business. It is just like an investment in subsidiary, because the director will not use this loan for the company purpose. It is a personal purpose. You have to classify it as a non-current asset. You have to understand that loans to directors are governed by section 295 of the Companies Act. There are a lot of restrictions, right, on the public company which intends to make any type of transaction with the directors, right? So you have to understand there are a lot of restrictions, right? And this particular section, right, this section is not applicable to loan or advance salary made to an employee. So that's why we are making the distinction. In both cases, whether it's to a worker or to a director, even though in both cases we are giving for the personal use. Even this worker is taking these funds out of the company and using it for personal use. Even this is, in a way, you can say this is funds diverted to outside the business. He is not using for personal purpose. The director is also doing that. But then this section is not applicable to loans and advances made to the salary. Usually this is a very small amount, but this directors is something which you need to watch out for. Actually, it's a very bad practice to lend monies to a director, even for a very short period of time, because some years ago there was this practice. Companies actually used to, what they used to do, they used to lend money to the directors, and just before the year end, when the year end is 31st March 2014, maybe just around some 7 or 10 days before, what they used to do, they used to borrow money from the banks in their personal capacity, and then used to pay off these loans in the company, right? What they used to do, first of all, they used to take loan from the company. Say, for example, on 2nd April 2014, they have taken a loan from the company. Then for 1 year, they won't repay. Then just before the financial year ends, that is some 28th March 2015, that's the next year. Just around that time, they will take some bank loan. They'll repay this loan, and again they'll reborrow it from the company. So this way they'll keep that loan off the balance sheet. So this is actually a practice that used to be followed. This is not to be encouraged. So whenever you see the items called dues from directors, please classify it as a non-current asset. So with this we come to the end of this segment. So in this segment we have discussed various items that can come under non-current assets. So in the next segment we'll be discussing about intangible assets. So in segment 6.15, there's the next segment we'll be discussing about intangible assets. See you then.